Welcome to our panel discussion, Making Cannabis Unicorns a Reality. I'm Rami Al-Sheikh. I'm a partner at PwC, and I'm based in Toronto in Canada. I lead the cannabis practice there, and today I'm going to be facilitating a great conversation with great panelists around the cannabis landscape. So we'll be covering topics around market trends, financing landscape, listing challenges, new industry entrants and partnerships there, and we're going to talk about the anatomy of a unicorn. But before we get going, I'm going to ask the panelists to introduce themselves. So maybe I can start with Bill, then Josh, and then Matt.
Yeah, thanks so much for having me. I'm Bill Bocat. I'm a partner at the law firm of Fox Rothschild. I work out of our Chicago office there. And along with Josh Horn, who's here today, I co-chair the cannabis practice group at our firm. I've been doing cannabis law about 7 years now, since it first popped up in Illinois. But of course, now we do it across the country, representing either independent or multi-state operators across the country with M&A work, litigation, regulatory issues, disciplinary complaints, and in cannabis world, any other issue really that's expanding like some of the ones we'll talk about today. Otherwise, thanks for having me.
Thank you, Bill. Josh, could you please introduce yourself?
Good morning. My name is Joshua Horn. As Bill said, I'm a partner also at Fox Rothschild, co-chair the practice with Bill. I'm resident in our Philadelphia, Pennsylvania office. And I've been in the practice now for about 6 years. And the practice has over time focused more and more on mergers and acquisitions and financing arrangements. And in particular, my focus has been on the regulatory side of that, although I certainly know enough to be very dangerous on the corporate side as well, and do that throughout the country.
Awesome. Thank you, Josh. Last but not least, Matt, please.
Thanks, Rami. Thanks for the opportunity. I'm also an attorney at Fox Rothschild, and I'm very proud to be appearing here with my partners, Josh and Bill. I'm a corporate attorney. I am the co-chair of our national M&A practice, and I've been working, like Bill and Josh, basically since the inception of Fox's cannabis practice. We have one of the oldest, most established, and most robust cannabis law practices anywhere in the corporate space. So initially, that meant a lot of financing rounds at progressively higher valuations and getting more and more sophisticated, starting in the early days, probably 5 or 6 years ago, with very simple, very novel transactions in the space. And as the industry has grown, we've had the opportunity to grow our practice. We've been involved in many of the major M&A and RTO deals that I think a lot of our attendees are familiar with, and look forward to more interesting deals as we'll be describing kind of the future of the market today. And I'll just give a quick background. When we were thinking about something really dynamic and interesting to present to the growth network today, we thought that, we took a step back and we looked at where do we see our clients going? What do we think what's top of mind for our clients? And knowing that there's always pressure to get the financing, the next round of financing at a more meaningful valuation in a more meaningful transaction, we thought, what are we going to be seeing, we think, in the next couple of years? And that's how we hit upon the topic of unicorns that we're going to be discussing today, because we don't see any in the market yet, but hopefully we're headed there, Rami.
Perfect. Thank you very much, Matt. So thank you for the intros. Let's start with maybe Bill. I can start with you. What are the key trends, the developments that you're seeing within this industry, specifically based on your interactions with clients?
Yeah. Well, we're definitely kind of at a stage where a lot of trends are really kind of condensing into something. I mean, generally, when I go back, when I first got involved in Illinois, I was producing cannabis and quality cannabis, mainly for medicinal purposes. There's kind of a few areas that I've really seen just in the last 12 months pull together. People talk, for example, a lot about brands and establishing brands as a national trend. And, the more M&A work that we've seen across the country with some of our clients who maybe have a couple of dispensaries in Pennsylvania, then some in Illinois, then some in California. How do you pull that all together, right, into a national brand? And people totally talked about it a lot. And I see that happening. And even just today, seeing one of our clients coming out with a live resin vape pen, which to me seemed pretty amazing. Really taking and putting into a vape pen some high-end cannabis that's like a dab product, really, and trying to take cannabis and make it into a craft, a connoisseur product like that, like you see with whiskey. People just don't buy whiskey, they buy a type of whiskey, you drink it, people talk about how long it's been aged in the bottle, the nose, the flavors, and I really think that branding along with that kind of evolution of a cannabis consumer product and trying to make that on a nationwide basis is really what's going to differentiate certain people, and of course bring the numbers up and the capital with it. And a lot of that's not just for business per se, but also for the one day when federal law might change and now you can have your brand a national brand and have that recognition. I see that happening a lot and kind of an accelerated pace, really. But in along with that, the retail store thing, the other trend that the pandemic has really caused, from a consumer retail point of view, we've seen in Illinois the curbside pickup and the delivery, things that states would never have done. Pennsylvania wouldn't have done it. Illinois wouldn't have done it. Pandemic caused it. And suddenly people realized, oh, I guess you could do this. And it's not going to be, cannabis running in the streets and among high schoolers and things like that. So I think the retail experience and the branding have really kind of moved at an exponential pace just in 2020. I think that's going to continue for a lot of the companies to try to differentiate themselves.
Got it. Thank you. Very helpful, Bill. Josh, what are you seeing?
So it's interesting. I think you can look at the industry in a pre-COVID and a post-COVID environment. Pre-COVID, I can remember when we were at MJ Biz last year and connected with clients, there was no money. There was no money to be had from a financing standpoint, or very little. And the market was much tighter than it was, say, in December 2018. But the thing about COVID in particular, where most of the retail businesses were deemed to be essential around the country, these businesses actually, some who had never turned a profit, all of a sudden now are making money and turning a profit. And I think what that has then fed is, companies are now able, and we'll talk about it more in a bit, to explore different forms of finance. But more importantly, it has also spurred a tremendous amount of consolidation in the space, where there are certain companies who were not so successful are now either being gobbled up entirely by larger MSOs, or assets are being picked off around the country because they just can't withstand their business model anymore because the economics, world economics being as tight as they are. But for those who have developed a successful business model and have solid management and have been able to reap the benefits of being an essential business in the COVID world, you're seeing more and more M&A transactions. And Matt and I are working on one right now with Bill, potentially a rather large one, and there's ones below that are all cooking along. I'd probably have 4 or 5 that are active at this point. And a year ago, that just wasn't the case. And so I just think, this post-COVID, where companies are able to turn some profitability, is justifying the prices, and it's opening up a market for mergers and acquisitions.
Got it. And you know what, Josh, we're seeing the exact same trends in Canada. The competition is increasing a lot as well here. I'd love to hear from your perspective, Matt, because I know you work with a different portfolio of clients as well. What are you seeing from your perspective? What are the key trends that you can share with us?
Yeah, I agree with Bill and Josh, and I'll underscore that that we're seeing consolidation in the market, but the trend among all of our clients is meaningful action, right? And so when you're talking about consolidation, or you're talking about growth, or you're talking about growth strategy, we're talking about established players at this point. And then I'll make a distinction because I think there's still room for new entrants. But for established players, I think it's less of a frenzy to get somewhere without knowing where you're going, less running feeling like you have to run in a particular direction. Feeling like you have to run without knowing the particular direction you're going to be running in, and more thoughtful action. And I think that's a result of other things that are trending in the industry, which is more professionalism in terms of who's coming into the management schemes now. You have people defecting from more traditional industries, like lawyers joining as general counsels. You have people from investment banks dealing as investment management personnel. You have, at this point, even second and third generation CEOs of first failed companies that were pioneers in the space, who did a great job, but notwithstanding the fact that their brands no longer exist because they were either acquired or no longer exist for whatever reason, whose experience is valuable and being tapped and consolidated into the management of the industry as well. At the other end, and to riff a little bit off of what Bill was saying, I see the realization of something that was discussed prior, but now is really being implemented, which is the connoisseurship, the divergence, I guess, between the big multi-state brands and the connoisseurship and kind of the boutique brands still growing. I think that there's enough data and consumer experience in the market now to help businesses understand, okay, there's this broad market that we want to address to become a stable consumer product, either in a state or states or at a national level where it exists. But then with that comes kind of something to define yourself against, which is we don't want to be the biggest. We don't want to be the lowest price. We want to be the nichiest, the best product in a particular vertical. And so I think now that there's enough consumer data out there to make companies that are just getting started confident that they can release these niche products and still maintain high value on the products that they're releasing and still follow a passion. And so I like those projects because brand to me has always been one of the more compelling aspects. And those, those are real brands. And so like, if you look even in our market in New York, which is still very marginalized, there are entrepreneurs here in New York who are really thinking about, okay, when New York starts to really turn a corner and have meaningful participation of a consumer market, whether it's initially just medical or whether it's ultimately retail for the adult use market, how's it going to look in New York? Is it going to be about New York's hip hop brand and culture? Is it going to be about New York's culinary scene? Is it going to be about the distinction of being distinctly Brooklyn or distinctly Bronx or something like that? And so I think that's stuff that I'm excited about seeing here, and that's some of the more cutting edge stuff that we're seeing in the market right now.
Yeah, I totally agree. I think the industry is maturing quite quickly. It's starting to look closer to CPG, where companies are more focused from a strategy perspective, figuring out where to play, where not to play along the value chain, what consumer segments to serve. So all of these trends resonate a lot with me. But there's a topic that Josh hit on, which is financing. And I'm very curious about it. What is happening? What has changed? So maybe, Matt, I can continue with you on this one. So how did the landscape evolve? What are the challenges? And what can we expect moving forward?
It's harder. I think it's harder to get financing, and we'll look a little bit closer at the data right now that supports that position. But so this slide I think is really helpful in that respect. There's some specific things about this I want to point out eventually, but generally I think financing is much harder. I think that the frenzy has been muted. I think that there's more investor dollars out there. There's more dry powder for sure. There are more funds being formed in New York right now, and those funds are larger, right? And so I was just having lunch last week with one of the few bankers in the space that's a legitimate federally chartered bank based here in New York that can bank banks in the cannabis, in the flower touching side of the cannabis industry. And we were talking about, how busy is he? What's going on? Tons of funds opening accounts with this bank, right? Lots of dry powder currently exists and lots of dry powder in the pipeline, and at increasingly larger amounts raised. But, the question is, okay, so now there's all this dry powder in the pipeline. Where's it going to be put to work? And I think that for better or worse for companies, they're going to have to, there's two kinds of companies out there. There are companies that were financed at peak valuations, and it's difficult for them because they're looking at down round or sideways round scenarios. In a lot of cases, unfortunately, they have convertible debt out there that was entered into at the height of the market in the first half of 2019, and now they've got about it's a 2-year instrument. They've got 6 months to restructure those instruments. it could be a magical time for them because of the volatility around the election. There's one camp that says if things trend a certain way through the election, there could be public market opportunity in the U.S. within the next 6 months, and that would be critical not only from a capital markets perspective in terms of providing liquidity in the market, but also critical for these companies that have notes out there, because they might be what was a difficult decision to make, which is whether or not to list on the CSE, because that played out with mixed results, could become a golden opportunity because they're forced to hit that finish line, by mid-summer 2021 to be public, and they might be the first ones out there. If you're talking about remaining private financing and sticking with the spirit of what we're talking about to build unicorns here, it's a golden opportunity also, but much harder because you have to no longer can rely on multiples of projected earnings in terms of your valuation. I think that there's enough data in the market right now to support more meaningful valuations based on actual performance, which is a harder metric for companies to hit, of course. And I think there's a lot of capital out there, but I think it's a much more disciplined investment environment, Rami.
Got it. That's very helpful. What about you, Josh? What are you seeing? What's your perspective on financing?
Right. So my perspective is consistent with Matt's, but a little bit different because the focus of my practice has been a lot more in the regulatory space. But you're seeing, I think, there are additional funds out there, and you're seeing more creative financing. Typically, the typical client would do a Reg D offering, which is a private securities offering, and issue units or shares pursuant to that. And we still work on those, certainly. But you're also seeing your clients starting to put together Reg A offerings as a precursor to try to get on a U.S. exchange. But then there's debt. And so debt has now taken multiple different forms. Matt and I worked on a cross-border transaction with the Canadian holdco that was deploying capital in the U.S. for flower-touching businesses in the U.S. So those are the type of creative financings that we're seeing. You also are seeing a lot of activity in the REIT space, and we can talk about this a little bit further later when we talk about partnerships. But what you're seeing is companies in the grower processor space or cultivation space are selling their building and their land for a premium, and then renting it back from the REIT and using that capital to finance either operations or expansion. And so that's now become very popular. There's a publicly traded REIT in this space who does it. And there's certainly plenty of non-publicly traded private companies that are doing as well. And then you still have convertible debt that clients are issuing because it's very, very, very difficult to securitize assets in the cannabis space, because depending upon the state that you're in, and that's one of the things that drives this bus here, are the laws in each state are different. You can't securitize cannabis in many states. Some you can to some degree, but you can't do it in other states. So how are you what's going to be the security for any traditional debt financing, which is really a challenge because, companies that are not traditionally in the cannabis space but are looking to get into it, they want security in the permit or the license, or they want it in the cannabis itself. And in most jurisdictions, you can't give either. So, and if you do, you're in violation of the law, and your permit or license could be adversely impacted. So there's a lot of challenges from the regulatory context in order to do, what people would otherwise consider to be traditional debt financing. We've also done some equipment financing arrangements, which is, that's a little easier because you have the equipment you can take back. The only problem there is, from a regulatory standpoint, that I was wrestling with a client when we were creating their form finance documents, is if they take the equipment back, if the equipment has cannabis in it, can they really take it back? Because they're not permitted. So these are some very unique issues that creative lawyers will think their way through. But these are all things that are very much in play now in the space from a financing perspective.
Got it. So we've heard from Matt that financing is getting harder, but there is some dry powder. I'm hearing from you there's more creative arrangement now. I've always thought that financing, even since the inception of this industry, even in Canada, has always been tricky. But what about being publicly listed? So what are these listing challenges? What are the implications for these cannabis companies? And when can we expect these challenges to ease? Maybe Bill, you can weigh in on this one.
Yeah, actually, I want to go back, if you don't mind, and weigh on the other one just real quick. Just wanted to add to what Josh was saying about the prior question.
Yeah.
You know, the last few months, I have been seeing, probably 6 months, a lot more debt transactions going, just because the more established multi-state operators, with interest rates being zero and it's hard for people to get income, they don't necessarily want all their money in the stock market. So, a lot of these companies have been issuing debt in blocks of like 100,000 here or there with really attractive interest rates. You're seeing 8, 10, 13, I think 16. So definitely an alternative when shareholders don't want to get diluted. The companies seem pretty healthy if they're the larger companies. And in some cases, Josh raised the issue about, trying to collateralize and how do you do that? But generally, oftentimes in some states you can collateralize, the membership interest, of, company has treasury stock or there's majority shareholders or something like that. So sorry to bleed into the old question, just had to get that out.
No, that's very helpful. So what are the challenges in terms of being publicly listed here, Bill? Like what are the implications for the cannabis companies?
Well, at least to be publicly listed in the U.S., which is obviously a dream for many of our clients. Unfortunately, you cannot be publicly traded on New York Stock Exchange or the NASDAQ if you engage in federally illegal conduct. That's obviously the reason everyone went to the Canadian Stock Exchange, in some cases the NEO. But it's interesting because you have the companies that are operating in Canada generally who are traded in the U.S., right? And then the companies that are operating in the U.S. traded in Canada. It's a beautiful partnership. But I guess the big question is that being whittled away at all? We still have the pink sheets for a lot of the companies that are traded, the Canadian Stock Exchange, some of the large players, GTI, Cresco. You can still get the pink sheets here. And sometimes that's your only way to buy them. If you're a retail investor like I am in the U.S., some brokerage houses, you cannot buy cannabis companies traded on the Canadian Stock Exchange. We can buy the pink sheets. So being able to get on the, in the U.S. and New York Stock Exchange or NASDAQ is certainly the goal. From what I've heard, some companies already have like shelf listings ready to go if and when federal law changes or the exchanges or the DOJ allow it, and that certainly could happen quickly under a new administration, right? There was a little chatter recently because there's some ETFs in the cannabis space, and Josh and I were involved with one recently, which actually is advertising that you can, they're traded on the NASDAQ and you can buy their ETF, and their ETF purportedly holds equity in U.S. multi-state operators. They don't hold it directly, so it's a little controversial. It's called a total return swap. So, someone will give a third party money. That third party basically buys and holds the stock for my benefit, or the ETF company. And then they keep telling the third party buy and sell. So they don't hold it. It's very controversial, but there is an ETF out there right now being traded in the U.S. with that model. And, that obviously has implications for everyone else because, excuse me, if you can do that, why not just directly hold the equity and be traded on the NASDAQ or New York Stock Exchange? No one's really pushed that yet, but I think it's raised a lot of questions. And I think if we have a new Justice Department and things change in the next few months, just politically, without even changing the laws per se, one of these exchanges might let someone do that. And I think we'd see kind of a bigger rush of some of the large cannabis companies being traded in Canada, dual listing in the U.S., which obviously would increase, I think, the volume of the buys and sells for a lot of these companies, and just the image and how the U.S. investor perceives it now that it's being traded on New York Stock Exchange. But we're definitely at the precipice, I think, of what could happen in the next 6 months in that regard.
Got it. That's very helpful. Matt, what is your perspective on this?
Yeah, I appreciate that, Rami. And if you could go back to the last slide real quick, it'll segue into what I think is the one of the critical problems here, or challenges here. So if you look at this line closely and you see what's going on in 2020, you'll see something really weird going on here. You'll see that, notwithstanding what Bill just said, which is that the U.S. markets are really restricted in terms of the capital that can be raised here, you actually see more capital raised in the U.S. public markets than the Canadian markets for the first time probably in the last 6 months, right? And so that's a weird thing when you consider that cannabis is federally legal in Canada and federally illegal in the United States, and the public markets in the United States are federally regulated, and therefore there shouldn't be a lot of capital. You would expect to see in the Canadian markets a much more robust market there than you would in the US, instead of the flip in the trend that you see here. And so if you go to the next slide, please, Rami, we'll talk a little bit about investor fatigue. And so I think that if you look at the value of the Canadian public companies, even the great ones, the large market cap ones that are well over $1 billion on the CSE, they're at significantly lower values than they were off of their historic highs. And I think, unfortunately, that's just tainted the average retail investor away from the Canadian markets and reinforced over time. As the economy's gone up, the economy's gone down, there's been a global pandemic. The rest of the markets have the rest of the public markets in the US have pretty much bounced back. But you don't see that bounce back in your Canadian portfolio on your cannabis investments. And so I think that there's investor fatigue around that. And I think that creates a lot of inertia until there's a meaningful change in the industry, something eye-popping, something newsworthy, like major jurisdictions that aren't yet adult use coming online in the US, right? And that could happen in the next 2 weeks. There's a lot of early November referendums and votes on that in meaningful jurisdictions, including here in the Northeast. So that might increase public perception and value. But right now, I think that the inertia against the public markets is one of them. I think also, if you look more intrinsically at the companies, and the growing, and you listen to the analyst calls about what the challenges are internally within any particular cannabis publicly listed company right now, you can get a general sense that these companies were never really designed or staffed or managed to be public companies. And so initially, I think you can you could have used the momentum and the excitement and the fervor in the market to get past those points. But as you see them go into second and third and fourth year of operation as public companies, you see the friction that causes internally, and they have to restaff and they have to redo things and they have to destroy a lot of product because they overbought, or they have to shut down entire divisions, whether they're non-US, non-Canadian foreign divisions like in South America or in the Caribbean or something like that, because they were visionary when they were established and capitalized, and now they're operating and they have to pull back. And so, you have to think about kind of the first and third bullets that we have here on expensive, time-consuming, and invasive nature of being a public company, and really what that means, as well as the demands on human capital in the public companies. And I think that, again, as we were talking about some of the trends that we were seeing a couple of slides ago, there's two sides to this coin. On the one hand, you see more professionalization of the companies and of their human capital resources, and that's amazing. And I think that's in direct response to this, and I think that primes companies to go public in the U.S. Or a second generation in Canada, as well as primes them to be for there to be unicorns in the future. But it's also a drag on the current companies that are out there, and creates some investor inertia as well.
Got it. Thank you, Matt. That's very helpful. Let's switch gears to partnerships in the industry. I'd love to hear from your perspective, what is the intersection between cannabis and adjacent or competing industries, and what new partnerships can we expect moving forward? So I've heard some of it from Josh earlier today, but I'd love to get your perspective. So maybe here again, we can get Bill to weigh in on this one.
Yeah, I'm happy to. One of the partnerships that we've had more direct experience with, we have a client who works in the alcohol industry. With if you go to California, you can get the Lagunitas High Tops Ale. It has really no alcohol, but it's like a hot brew, very popular. And I know that a lot of other alcohol industries are looking at ways to get in on the cannabis industry. Obviously, for the industry, alcohol and cannabis, it's all about market segmentation, obviously, right? And there's certainly alcohol is seeing this cut into their revenues, and I don't think it's going to go on forever. So forming partnerships like Lagunitas did or other companies just seems like a natural fit. I know there's a wine company also in California, low or no alcohol, I believe, but has some THC and tastes like wine, but has a slightly different flavor profile. It's all about market segmentation. Biggest glitch for the partnerships like this is the distribution thing, right? I mean, cannabis operators are used to, growing and selling in their individual states. Well, alcohol has distributions, models that does somewhat work on a state by state basis, but it's got a little different challenges. Certainly if federal law changes, I can easily see more beer companies, partnering to create things like High Top Sale and going around the countries and being able to go over state lines. So much is happening probably in the next 12 months with this election and what could happen politically with cannabis. It's certainly hard to say. But tobacco is also a natural partnership too. I mean, in just the delivery systems. I know some of the international cannabis vape pen operators have been in talks and across the country. They have a distribution network. A lot of the states are clamping down on nicotine and tobacco, but being more welcoming to cannabis products, right? So you've already got the structure set up. You've got the equipment in these pens. A lot has been brought about child safety and using a trusting distribution network. Well, it's certainly a better trusting distribution network to sell these products through licensed dispensary than it is at 7-Eleven, where children are getting access to them, and that's causing a big uproar. So I think that network is in place if the laws can change. Those are the two I think that we'd see a big turn on quickly. Obviously, pharmacies and retail I kind of put together, at least for medical cannabis. That would obviously need a radical change in the law to be able to get cannabis at pharmacies. But if it's descheduled or scheduled in the right way for medicine, I could see it being very much like the Israeli model. We have certain brands and strains that are of a certain quality that doctors are familiar with and are packaged at pharmacies. Israel is clearly ahead of the U.S. in that regard.
Got it. A lot of the things that you're mentioning resonate with me because we've worked with global beverage, alcohol, and pharma and tobacco companies, and we found that the two key issues they encounter is the route to market. Sometimes it's different with cannabis. The other challenge, what I'm finding, especially with these global players, is there's traditionally more stigma with cannabis in Europe, so they're reluctant to enter. But when you speak to global players that are based in the US, then they have more appetite to enter the cannabis. They're just exploring the other challenges, how they can overcome them. But on this topic specifically, I'd love to hear from Josh and then Matt. So maybe, Josh, can you weigh in here?
Sure. So to pick up on the things Bill was talking about, you've already seen big tobacco in the form of Altria and big beverage in the form of Constellation Brands enter into arrangements or ownership interests with Canadian publicly traded cannabis companies. And I think what that shows is, those companies have that appetite for risk. And I think they're just biding their time for federal legalization in the States so that they are then well positioned to jump back over the border, come back to the lower 48 and have, a beer and alcohol cannabis infused business as well as, in tobacco space. But I think an interesting trend that you do see, and I'm going to shift gears a little bit, is there is a trend already in the US, and that's really in the hemp CBD space as opposed to traditional cannabis space, because you're seeing hemp CBD products being sold in pharmacies in the retail space. And you have GW Pharmaceuticals, who has Epidiolex, which is the first FDA approved drug that was derived from cannabis and CBD in particular. And I think what you're seeing is, those companies like Bed Bath & Beyond, for example, I think CVS and Walgreens are selling some products, but they're typically selling only topical products as opposed to beverages and food because of the FDA's position on CBD in food and beverages being illegal. And so you can't do it. But the FDA has traditionally taken a hands-off approach on topicals. So you're seeing that slow entree into the cannabis space, such that those retail chains of pharmacies, when, and not if, but when, cannabis becomes federally legal, they already have their systems in place to basically, supplement their CBD from hemp with their CBD from traditional cannabis. So I think that's happening. just slowly, but I think companies who are going to be successful when there's federal legalization or reform in the U.S. are those who have already gotten their foot in the door now, either in Canada, like I mentioned with Altria and Constellation Brands, or here in the U.S. through the CBD and hemp space. So I think that will be the trend.
Awesome. Thank you, Josh. Matt, what are your views here?
So building off of what Josh and Bill have already mentioned, I think it's interesting if you think about it from a slightly different perspective, which is why have a bunch of really small companies, even the good ones, meaning relatively large, relatively well capitalized, relatively sophisticated, had to reinvent the wheel on how to make a cookie and package it and sell it, or how to make a gummy and package it and sell it, right? Like, you still don't see consumer brands out there. And I'm thinking specifically in the edible space, which are really the staples. And if you look at trends from COVID, general market trends from COVID in the last 6 to 8 months, it's the return to familiar brands, right? Like, people have migrated away from this health conscious consumer behavior to more comfort foods, more staple brands, things like that. And there's kind of more desire than ever to kind of for comfort brand affinity, right? And nonetheless, you still haven't seen one meaningful, even in the markets where adult use is robust, one meaningful participant from a Nabisco or a trying to think of like a major candy manufacturer or something like that, right? Even though that's typically what you see on the shelves when you go to a dispensary, those kinds of products. And so there's a major inefficiency in the market there, and we all know that that's not because Fortune 100 companies that are consumer staples are not interested, right? We're constantly engaged to advise those companies on potential entree into the market, as I'm sure you guys are over at PwC, Rami. And the question is, when will there be enough? Often the big picture question that we're asked to answer is, when will be the right time? How do we get far enough ahead in our R&D so that we can release a meaningful product exactly at the moment when it's allowed to be released, right? Without having to take aggressive or creative or risky positions with our staple brands. And so, in addition to everything Bill and Josh are saying, I think you're really going to see probably fall like dominoes at some point. And I can't really figure out when that point is, because these brands are thinking about these things in the background, and they're trying to figure out how to do it at massive scale. But the reputational risk and the real legal enforcement risk are still large enough that even with those data points out there from the handful of Fortune 100 brands that have released products that are meaningful in the space, but aren't obviously infused products. But I'm thinking, for example, of like Scotty's Miracle Grow and the specific soils that they produce. They're not quite there yet. And I think that I don't know what the tipping point is going to be, but I think what you're going to see is actual brand alliance and brand naming in the space at some point. I'm surprised you haven't seen much of it yet, but you have seen, and this is interesting, you have seen enforcement, those brands enforcing against parody brand on their products off of the shelves, not only to protect their brand names and to protect their brands, but I would offer that that's also done because they might want to be entering into that space, and they want to make sure that there's no confusion in the market when their product actually shows up on the shelves. And so that's where I'm hoping it's going.
Got it. Very helpful. Very helpful.
Pick up on one thing that Matt was saying, because you already see, and he raised the perfect example, Scott's Miracle Grow. It's my understanding they're publicly traded on the New York Stock Exchange. A significant part of their revenue now is generated from the cannabis space. So you're already seeing some partnerships in this context. So they're not selling cannabis, but they're supplementing the industry. Bill, for example, represented a lighting company that does a significant amount of work. Lights are very important, obviously, for a grow. And he has a client we did some work for who's in the lighting space. And so you're going to see more and more of that already, as opposed to the kind of the things that Bill and Matt and I were talking about of companies getting into the cannabis space, such as Scott's selling, hypothetically, their own cannabis brand, as opposed to Miracle Grow so that you can grow a better plant.
Yeah, well, you do have, we have celebrity brands too. I mean, we see that a lot, right? In Illinois, Blues Brothers brand. Obviously, you got Cheech and Chong and Willie's Weed. I mean, although, I don't, what that brand lends to it besides a lifestyle purpose, it doesn't necessarily come with a food making brand, right? Like Nestle or something like that. So maybe it's a novelty or an image, but that's the best we get. But certainly, Josh, you raised a good point, because I remember I was speaking about a year ago or more at a baking manufacturers association who's looking at getting in. How can their members maybe get into the CBD or cannabis space? And this is some of the most established, S&P 1000 companies that create foodstuffs who are there. They see it happening. They're like Matt was totally right. I mean, they've been seeing it happening for years. They don't know where their entry point is. I think their entry point is when it's federally legal, obviously, because most of them are publicly traded, or they're just generally more conservative companies. But they are watching it, and they are looking for their entry point. And I do think when federal law, if it changes, or there's a different administration with different enforcement priorities, a lot of them are ready to pounce. And you may see some more traditional foodstuff companies bringing their economies of scale, their techniques, their quality control, their taste, flavor profiles, and it could change pretty quickly.
That's fair. Gents, let's talk about unicorns. I think the topic of partnerships is fascinating, and I think we're going to see more partners moving forward. But I want to talk about unicorns, and we haven't seen one in the market, in the private market space so far. So maybe Matt, I can start with you. Maybe you can tell us, what is the profile or DNA for a unicorn, and when can we expect to see one?
Yeah, thanks, Rami. So it's a term and a concept that we're borrowing from tech, and it's the general position that a company that's reached $1 billion valuation without having to take public capital, right? It's interesting. Historically, that's what tech companies strive for. It was a reaction to the bubble bursting, around the change of millennia in 2000, and this general sense that a lot of these companies, except for a few very notable tech companies, a lot of these companies wanted to stay private longer. They wanted to stay private longer for a lot of reasons. One was to create more value for the founders and for the early employees, and to mint more millionaires ultimately on exit. Another was, and if you talk to certain funds here in the U.S. that have invested historically in cannabis, and this is their thinking as well, they don't want what they would call like the whiptail reaction to the market on a daily basis, waking up and basically having to think, okay, what's going to happen to my stock today? What decision am I going to make today that's either going to bolster or diminish the value of my company? And have to spend a majority of my time as a CEO or an executive at this company worrying about stockholder, instead of creating value for my stockholders, worrying about what the market's going to react today, and is it going to react well or poorly to the next important corporate decision that I make. And so that pressure, and so being a unicorn and getting to that $1 billion valuation gets you away from that pressure. The reason they haven't existed historically in the cannabis space is because they're, from my perspective, there hasn't been enough private capital available to put to work at high valuations, that, approaching the $1 billion valuations, that wouldn't be basically taking out the company, 10 times over, right? If the company can only justify a $250 million valuation, but they're only looking to raise 10% by selling their capital, there's such a disconnect there between the amount of money that they need and that they're trying to raise in their current valuation, and they're not trying to sell, and so they're stuck, right? And so historically, what companies have done is they've been small cap and gone to the Canadian public markets, right? Or just try to grow organically, which is never a good model for accelerated growth, for venture capital type returns. Slow organic growth isn't going to do it. And so we're thinking that now might be the time, Rami. I think that, notwithstanding the momentum for either a second generation of Canadian public companies that might be coming, or first generation U.S. public companies, depending on the things that Bill and Josh have already highlighted. Even if there's a great opportunity for cannabis companies to go public over the next 1 to 3 years, I think that there's going to be a subset of eligible candidates that are going to look at those opportunities of either RTOing or merging with a public company or going public in the US if that's available, and deciding we want to stick around like we are. We like the way that we operate. We've got a clear business strategy to get us to that $1 billion plus valuation. We've got the seasoned executive team in place that can run a company. And there's a template. If you borrow executives from the tech industry or from certain consumer products companies, and now that there's stability in cannabis companies for people to feel like they're not throwing away their career 20 years into it by migrating over to a cannabis company because they can pick some winners, and really woo high class, desirable, key desirable executives out of those companies and into a more dynamic environment without taking the startup risk, the bet the farm risk of leaving their, those executive jobs. You marry that with unique defensible brands that are really being built, which gives executives confidence to come over, that gives investors confidence that they don't have to be tied to a Fortune 500 brand through a partnership, or they don't have to RTO with another established brand as unique defensible brands are built, and say there's something here that I could see that's scalable at the $1 billion valuation, right? Which is IP, brand, things that have intangible value beyond how many acres you can control or how much production you can put into the pipeline or how low you can get the cost per pound or something like that, which are important metrics, but don't scale at the same acceleration as a unique defensible brand, in my opinion. And then, on the back end, you have finally companies that have 3, 4, 5, 6, 7 years of operational value in operational numbers, so that they can show a trajectory, and you see profitability for the first time now, but you see defensible numbers and slow, controlled growth that will give confidence to investors like family offices and like institutional investors and like more conservative investors who are raising private funds right now to make investments with the expectation, right? When you have a private equity fund or a later stage investor kind of investing in the unicorn round, they're not looking for 20 to 50x returns like an early stage venture capitalist. They're looking for like a 3 or a 5, right? And you can start to project that out with stable track record. And they just want like a nice performing asset. So I know I went through our entire unicorn box here, but I'm sure Bill and Josh have some thoughts also on what they'd like to see.
I'd love to hear from Bill and Josh very briefly, and then I want to move to our predictions for the next 12 to 18 months. So maybe Josh and Bill, if you can comment briefly on the unicorn concept.
Sure. Since Matt took all of our time, it's just joking. A couple of observations that I've had in the space is, there's a desire not to be publicly traded also because it gives you greater flexibility. You don't have all the reporting requirements. Obviously, you don't have to file your 10Ks and your 8s and all that, which is a significant infrastructure drain. So that's number one. Number two, you're seeing the better, more sophisticated MSOs hiring people for their C-suite from the publicly traded space. We have a client that we're doing a lot of work for now. Their CFO was a CFO in the public traded space. So they're getting that type of infrastructure without being a publicly traded company and getting the benefit of that institutional knowledge. And you're seeing a lot of these companies, although organic growth alone isn't really sufficient, but it's really strategic organic growth. You're seeing companies now from the West really flooding to the East because of the perception that adult use is coming. Like, for example, Pennsylvania is the 5th largest population in the country. So everyone's trying to get medical marijuana permits here in Pennsylvania, and none of them are available for sale. So and that's going to just drive up the valuations in these companies. Why I think companies are going to try to stick it out to become that unicorn.
Very helpful. Let's move to the predictions. So we're nearing the end of the session. Maybe I can start with Bill. Like, what are your predictions for the industry for the next 12 to 18 months? And then I'll turn to Josh and then Matt.
Yeah, thank you. My prediction, I'm trying to think, I'm trying to figure out how to phrase it because I see something happening, but I'm not quite sure how to predict how it's going to end. But so I'll just throw it out there as an observation. Obviously lots of states are coming online. They might next week. If not next week, I think with the pandemic, a lot of states that were on the sidelines and maybe weren't sure if they wanted to go to adult use, New York, Pennsylvania, come springtime, all these General Assembly sessions are going to wrap up and they need jobs and tax dollars. And so I think there'll be a lot of cannabis expansion. But, how does the expansion, how does that work with multi-state operators trying to expand? And what I mean by that is, all the states that are coming online are passing these social equity provisions, giving priority in competitive license applications to so-called social equity applicants, defined differently here and there. I'm in Illinois where we have a huge social equity program, a little controversial, but, the point and the reason and the restorative justice behind it, I think most people agree with. I do. But then how do MSOs get into that market in a real way, because they're publicly traded and they don't have a demographic, they don't have an arrest record? How do they break into these new markets when they're designed with little individuals? And so I think that's the challenge. The multi-state operators have access to the capital, the quality control. They have seasoned operations. They get a new license in Illinois, Pennsylvania. They could be up and running, deal with the zoning. But if you're setting aside licenses generally to newbies who deserve it and qualify as social equity, that's all well and good. But then how does that affect the branding, for example, that we were talking about? Because now you have lots of little operators. I don't know how that's all going to resolve. I see it as an intersection coming together, and so I'm just not quite sure how it's going to work. I did personally, back in the day when I first got involved in cannabis, I don't know, 7 years ago, a lot of people were looking for brands because they had cultivating licenses, processing license, and they can sell those brands to all the dispensaries. I think at a certain point, a couple of years ago, a lot of those companies saw a lot of the money going for vertical integration, and they wanted dispensaries. And Matt and Josh and myself dealt with a lot of clients, taking some great opportunities in buying and expanding by acquiring dispensaries. But if a lot of these new licenses are for individual social equity applicants, as they should be, that have some restrictions on just anyone buying them, I think maybe some of that branding may have to kind of retreat a little to less vertically integrated, maybe to more cultivating processing licenses, and then getting those brands into dispensaries that are owned by social equity applicants. So I guess my prediction is, just watching and seeing how those interoperate, and I'm not quite sure how it's going to work.
Awesome. Very helpful. Josh, can I turn to you quickly?
Sure. Yeah. Quickly. I think you're going to see a lot more consolidation in the market. You're going to see a lot of smaller companies get bought out. You're going to see probably more, not necessarily mega deals like we've seen in the past, but you may see strategic acquisitions, although it could be a mega deal, but it's going to be strategic as to where the underlying assets are located. I think regardless if there's a new administration or not, I think in the next 18 to 24 months, you're going to see some cannabis reform at the federal level, either through the Safe Banking Act or the MORE Act. I think one or both in some form will probably pass, and that'll just be a precursor for larger reform down the road. But I just think, particularly banking, I think is probably, in my predictions, will be the first place to get some relief because banking has been such a problem in the industry. We had a client in Colorado who was a very large player in Colorado, and before they were able to get a banking relationship, they had a warehouse that just stored their cash. And so I think there's a lot of pressure at the federal level on the banking issue because, even from the current administration, you want to get these dollars in the economy and not just sitting in a warehouse. So I think that's my view. In the next 18 to 24 months, that's probably what we're going to see.
Very helpful. Thank you, Josh. What about you, Matt?
Yeah, we threw out there that there might be a magic year out there, and I think that there's people who don't work in this market on a daily basis might think like, oh, someday there's some date certain where it's going to be federally legal in the United States by a particular law. In reality, like most meaningful large changes, it's probably going to happen in small pieces, right? And so Josh already alluded to the change in the banking industry, and another area where we see a lot of it happening is in the first creditor enforcement actions, right? And so we've had clients that have tried to bring enforcement actions against secured instruments that we've put together, or unsecured creditor claims in certain jurisdictions, try to navigate the area, the space between federal bankruptcy, which doesn't recognize cannabis protection right now because it's federally illegal, and the state by state in the U.S. State by state processes that might exist to protect creditors in those circumstances. And so I think that law, for example, is going to start to become, there's going to be meaningful case law there. People are going to go the distance. Creditors are going to go the distance in fighting those fights and paying those legal bills to get that precedent set. And so I think you're going to see, in addition to the banking that Josh alluded to, you're going to see more clarity on creditors' rights and things like that. And all of these data points, as they're built together, and same thing goes for other kind of verticals in the legal area, whether it's IP or whether it's IP is another good example. And over time, you're going to see building of what will ultimately be support for a federally legal or deregulated system in the United States, built on kind of these pillars of individual parts of the legal market. And then beyond that, I think you're going to see special situations workouts as those distressed deals work their way through the pipeline. I think it's going to be rocky for a little bit longer. I think it's going to be hard for the vast majority of companies out there. They're going to struggle. Many will fail. Some will get acquired. And the big ones will keep getting bigger. And then that brush clearing is going to create space for a second or third generation of boutique brands that I think are going to be really sticky.
Got it. We've heard great insights today, specifically on financing, listing, partnerships, and I loved your predictions, guys. I want to thank the panelists for their contributions today. I want to thank the audience for joining us today. And now, Matt, I'm just going to turn to you for some closing remarks, and thank you for allowing me to facilitate this conversation.
Thank you.
Absolutely. So, Rami, thanks very much. For those who weren't involved in the planning, I'll let them know that Rami came a little bit late to the game and in just a couple of weeks pulled this whole thing together with us and kept us right on schedule. So thanks very much to Rami and PwC for jumping in and doing a great job moderating. I want to thank also everyone over at Growth. We've had our eye on working with Growth for a long time, basically since it was conceptualized. And even though we weren't able to do this in person, which we were excited about for next year, they've been phenomenal in supporting this platform and our ability to kind of reach everyone. I'm having a great time going through all the programming that Growth has presented already today. I'm looking forward to that over the next day and a half as well. Fox Rothschild is a national law firm in the United States. We have offices in almost, just by good luck, have offices in almost every meaningful U.S. jurisdiction where the adult markets and the medical markets are being pioneered. It's given Josh and Bill, as the co-chairs of our practice group, and the rest of our dozens of attorneys who work in this space, probably one of the most meaningful platforms that you could engage clients as a law firm on. And so, we've had the good fortune to work with almost all of the really large and nascent brands that are out there. And we look forward to connecting with more brands through our partnership with Growth and, staying on top of it. And it's an exciting area of law and we love working in it. So thanks very much.